Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, October 20th, 2023. We'll start with our executive summary from our leadoff morning note. As always, if you want the analysis supporting these conclusions, as well as what to actually do about it in your portfolio, you need to become a subscriber of 42 Macro. So we'll start with number one is investors continue to sell the rip in stocks and underweight cyclical sectors and factors in line with the recent transition to a risk-off, top-down market regime, i.e. inflation. The latest from the Israel-Hamas war is that it is indeed broadening into a regional conflict. Number two, Brent crude oil is rallying back above $93 per barrel for the first time since the start of this month, indicating investors are skeptical at how fast Venezuelan production can come back online if sanctions were broadly to be removed, because the sanctions starved its energy industry and economy for years. And then lastly, number three, the PBOC, People's Bank of China, injected a record 733 trillion yuan, which is $100 billion, of liquidity into the Chinese financial sector via short-term reverse repos after 7-day interbank repo rate spiked to the highest level since April. Beijing's recent public borrowing binge was largely responsible for the tightening of liquidity conditions in China. The increase in central government borrowing suggests incremental fiscal stimulus is being or soon to be deployed, which is supportive of the Chinese Communist Party's ability to beat its 5% target for 2023. The People's vision to keep its benchmark 1-year and 5-year loan prime rates unchanged at 3.45% and 4.20% respectively suggests Beijing is merely attempting to offset the recent decline in liquidity rather than signal a big change towards aggressive easing of monetary policy. Transitioning to our cross-asset performance monitor here, my Bloomberg, we'll start with U.S. equity sectors. S&P down 2% week over week, as I indicated. Selling continues. We got the market being led lower by consumer discretionary stocks at minus 4%, and consumer real estate stocks at around 4% as well. As I mentioned, U.S. equity is down 2% broadly from a beta perspective, being led lower by high beta, down 3.3%, and growth at minus 3%, respectively. In terms of the geographic performance, limited dispersion amongst geographies, with the exception of China getting absolutely crushed, minus 5%. That drain on liquidity from the public sector borrowing really did have a material impact in terms of draining liquidity from the Chinese financial sector, and that's why the PBOC had to step in today to sort of offset that at the margins. In terms of fixed income, fixed income, we got core ag down 1.7% week over week. The fixed income market is being dragged down by mortgage-backed securities, down 2%, investment grade down roughly 3%, and TLT down 5% week over week. If you missed that call, we said at the lows of the bond yields in last week, I want to say they were at about 450 on the 10-year and about 225 or 230. Oh, sorry, no, they got the 450 on the 10-year and right around 250 on the 10-year on the 10-year tips yield. We said you gotta sell them here. You gotta sell them here. Very unsustainable moves in the context of the top-down risk management, top-down market regime, in the context of the bottom-up market regime, and also in the context of our qualitative research views, which are calling for sticky inflation to become a consensus market theme in the coming months. In terms of currency market performance, dollars flat week over week. You continue to see safe haven flows into the Swiss franc, up 1.2% week over week. Currencies being dragged down, or the laggard in the currency market is the Chinese yuan at minus 0.7% week over week, now responding to the PBOC easing. In terms of commodities, the bull market continues. DBC's up 2.1%. That's the broad basket. You got commodities being led higher by precious metals and energy, up about 4% and 3% respectively. And then lastly, crypto. Bitcoin's actually having to move, really diverging from stocks, and converse to what we experienced throughout the spring and early summer, when stocks diverge to the upside for Bitcoin and crypto to the downside. Kind of the reverse is happening right now. You obviously have some fundamental news in terms of the ETF flows, people trying to gain that potential catalyst as well. So Bitcoin's up 9.3%. It's being led, crypto market's being led higher by Solana, up 23%. The rest of the crypto is lagging the move in Bitcoin. And then lastly, transitioning to my global our Lomo dashboard, we have several signals to highlight this morning in terms of the trading range. So the VIX is overbought here, so probably not the best spot to be chasing the short side of U.S. equities. This actually be a decent spot to cover a little bit of U.S. equities if you're a more tactical trader. If you're a more medium-term trader, this is we talked about this in our lead-off morning note, but certainly The discretionary traders among you need to check that out in terms of what that ultimately means in terms of some of the evolution of our signals. In terms of Bitcoin, we got a Bitcoin now, an overbought signal here. It got bullish medium-term and short-term price momentum, so definitely not a short signal there, but definitely a good spot to be taking some chips off the table if you've benefited from the month-to-date rise in the crypto market. And then lastly, Shanghai Composite, just getting absolutely just the gift that keeps on giving on the short side. We told you liquidate China in February. If you did, kudos. If you didn't, you maybe subscribe. So with that, we'll wrap it up. Darius Dale presenting our macro minute for Friday, October 20th, 2023. Best of luck out there today. We'll catch you back here on Tuesday. I'm offline Monday. We'll see you here for the Around the Horn. For those of you who subscribe to that product, thank you again. Cheers.